Looking for income? We got those 3 high yield that are not only generous, but they are safe. Disclaimer: the following is for education and general information only, not investment, legal, or tax advice, and not a recommendation to buy or sell anything. Investing involves risk. Dividends are not guaranteed, and past performance does not predict the future. I may hold position in securities discussed and may trade at any time. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast, where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Gold investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. We are on episode 4 of this mini series on to start the year on the right foot, and that was really hard to start the episode with. I am with my co-host, who's actually laughing at my face right now. So I guess you're doing pretty well, Véronique.
Well, you know what, Mike? I'm usually the one who's making the most mistakes recording these podcasts. So every time it happens to you, yes, I get the chance to laugh. Like it's my time.
Totally fair.
So yesterday we talked about the risk of chasing yield among other stocks because it was a pretty good one yesterday. But there are ways to find high yield stocks that are safe and that can bring you some peace of mind, especially at retirement. Today we will share 3 of them with you.
Yeah, so some companies will always pay a higher yield than the average, and it's not necessarily because they are bad investments. Some of them are just like have a high level of debt, growth opportunities that are limited, but they still manage to move the business forward and increase the dividend just a little to keep everything's going. So this is the target today of looking at those companies that I like to call them like proxies for bonds or deluxe bonds. So companies where I don't expect much in terms of stock price appreciation, but the dividend is good and it will continue to increase at a minimum to meet inflation.
All right, so let's start with a classic on the Canadian market, Enbridge, which also trades on the US side, by the way. So why is it a good choice, Mike?
When we think about high yield, we kind of like think naturally about Enbridge. It has everything a high yield stock should have. So long-term stability. So they have like those contracts that are like 10, 15, 20, 25 years with their clients. And those contracts for their pipelines are take or pay. So it means that even if you don't use the full pipeline, you're still going to pay a minimum to use that. So even if the market goes down for commodities, so oil or natural gas, because right now it's almost like a 50-50 play on both of them, well, Enbridge is sure to get a minimum payments for their pipeline. The other thing is we are in a critical need for energy. So that also kind of push on the take instead of the pay part of the contract. So Enbridge is pretty sure that they're going to get some good cash flow coming up, and they made an amazing comeback in 2025. So this year, I don't necessarily expect the stock price to go up double digit, but the dividend is not at risk. It has been increased by 3% again for 2026. So investors, you're going to sleep well at night with this one, very stable, and you're going to get your dividend paid every quarter.
Okay, but then why did you sell Enbridge a few years ago, Mike?
Yeah, it sounds like a cheerleader that doesn't know which teams to cheer on, right? So here's the thing. I bought Enbridge in 2017. Back then, I bought it because it was a very strong dividend grower, talking about 10% increase per year. So that's reason number 1. Reason number 2, they were in the middle of a fight with regulators, which happens from time to time, but that added pressure on their price. So I bought it on price weakness. So a great dividend grower on price weakness, kind of like Boxing Day here. So that's why I jumped on Enbridge. Fast forward at the beginning of 22, interest rate rose, the balance sheet was under pressure, and back then, now it's going back to a 3% dividend increase every year, and it kept on continuing. So it's not that I was afraid of a dividend cut or anything, but I'm like, yeah, well, there's a lot of pressure on the balance sheet. Interest charges keeps on going up. Enbridge keeps on borrowing money to fund all their 10,000 projects, and they have slowed down their dividend growth policy. So since I prefer to have companies with a 5+ dividend growth rate average, I just decided to sell at a big profit, seeing what's coming up. And I was super happy with the trade. It was aligned with my strategy. Good for investors that waited throughout the storm and now they made a comeback. But I'm not disappointed about my trade because it was more about the fact that Enbridge was not qualified as a strong dividend grower anymore.
All right, so the second safe high yield to discuss today is Canadian Natural Resources, CNQ. Why do you like it?
This one is a great play on the oil business. So I like CNQ for its oil sand quality asset. The thing is, they are sitting on a huge reserve and they can decide to ramp up production whenever commodity prices go up. And they can slow it down whenever they want as well to adjust when commodity prices go down. As long as the oil barrel trades above 35, $40, they are profitable, which makes them highly profitable anytime that we get a oil bull market. They make smart acquisition from time to time and they keep a stellar balance sheet. So they have a ultra focus on having not too much debt. And whenever they make an acquisition, they use their cash flow to pay down fast. It's a shareholder friendly stock where they mix share buybacks and dividend increases as soon as their balance sheet is under control. And one thing that I found quite interesting, and it was the same thing for Enbridge, but it was more surprising for a company that is directed linked to commodity prices. They increased their dividend during COVID in 2020. So almost the same week that Suncor announced a dividend cut, Canadian Natural Resources says, you know what? We're confident in our business model and our assets, and we're going to increase our payouts, even though the barrel traded at in negative prices at one point, believe it or not.
Okay, so is there any good reason not to invest in it then?
There's always a good reason or two, right? To say that the stock is going to crash and burn. Of course, the first thing is it's still going to be volatile and linked to the oil price. So even though they have a very strong business model, if the oil barrel goes down by 5% in a week, you can be sure that CNQ is not going to perform that much. The other thing
Mm.
is a lot of investors, like they remember CNQ in 2020, 2021, and now they think that it is this like unicorn growing double digit on price appreciation, offering like 2 dividend increases per year and going crazy. I mean, that was a very short period. And most of the time, CNQ is just a steady eddy offering a very good yield with a very good increase, but that's what you're going to get. So don't expect this one to propel your portfolio to new levels. And of course, I mean, it's not exactly an ESG investment. So you have regulation. We're still talking about oil sands here. So it doesn't fit for all investors according to their values. And they could also get more restriction in their production, increasing their fees and so on. So that's always a risk laying around any oil and gas stock.
All right, so last but not least, Vici Properties. The ticker is VICI. What's the thesis for it, Mike?
Very interesting REIT in a niche market, mostly having casinos. So they have prime locations in Las Vegas and like most of the businesses there, but they own other casinos elsewhere. And one thing that I found very interesting about this business model is you don't have that many property buyers in this field. So we're talking about
Mm.
large properties that are worth like millions and millions and millions of dollars. So when they make an acquisition, there are not that many players, so they usually have more negotiating power. They
Mm.
run on 40 to 50-year contract long, so incredibly steady, very sticky, because once you operate a casino, you're not going to change to another corner, right? So you want to stay there. Of course, those contracts include escalator rates, so they always match up inflation and more. So they are kind of like guaranteed to make more money year after year. And this is how they ended up being able to increase the distribution on top of offering a yield that is usually above 5%.
But Mike, Vichy is still pretty much under the radar. How would you explain this?
Well, it's still vulnerable to a weak economy. So you might be having properties in prime locations. Those are huge buildings and it's not easy to find a replacement. So if any operator is going bankrupt, yes, you're still going to have your priority, but turning this thing around, the cost of maintenance, having no tenants in the property is going to be huge. So this is still a risk. And I mean, as usual, there's no free lunch in finance. I mean, there's a reason why the stock, the yield is that high, and the growth opportunities are not, I mean, legend. There's some of
Right.
them they can grow by acquisition, but there's a limit of how big they can become and how fast they can grow as well. So again, definitely the type of stock where you don't expect much from the stock price, but with a good yield that match inflation and more, I mean, it's good to go and it can work as a bond in your portfolio.
Okay, so let's end this quick episode with a small guide on how to select safe high yield stocks.
So, whenever there's a company that offers a yield above 5%, it's a red flag. But it's just one red flag. It's just one metric. So, you don't have to buy or sell based on that. It's better to look at the dividend triangle. So, have a better perspective on the revenue trend, the earnings per share trend, and of course, the dividend growth. If there's no dividend growth and a high yield, now you're starting to have a problem. So, I will never invest in a high yielding stock that offers no growth, because the next step that you're going to look at is payout ratio. And most of the time, if you have a weak dividend triangle, no dividend growth, a high yield, well, you're going to have high payout ratio. And guess what? If anything goes wrong, the dividend cut is not too far. So
Hmm.
yes, it's one thing to have mature businesses that will act as deluxe bond, but they need a minimum of growth everywhere. If they're not able to do that, they will first go from a deluxe bond to a dividend trap because the line is very thin. And a good example here could be TELUS. I mean, that used to be a actually good company with balance of growth and yield, ending up to mature businesses slowing down. And right now looks a lot more probably past the mark of being a deluxe bond and probably being a dividend trap because no more dividend increase in 26. So this one, I mean, started very well several years ago, but as we go, not looking that great.
All right, listeners, we will share more stock ideas with you during our free webinar on investing in 2026. Live seats are limited, so make sure to save your spot now at thedividendguidedog.com/webinar. The instant replay will also be sent to all registrants. There are only 2 episodes left in this series already. If you need to catch up, hit our show notes, visit thedividendguideblog.com/261. And until tomorrow, stay invested.
Stay invested. Disclaimer: the following is for education and general information only, not investment, legal, or tax advice, and not a recommendation to buy or sell anything. Investing involves risk, dividends are not guaranteed, and past performance does not predict the future. I may hold position in securities discussed and may trade at any time.